Hello? I'm going to be writing on the board a lot. I'll only turn on the screen when I need it. Although for you guys, you can see everything, but it's mostly a reminder to me. When I start to refer to the screen, I want to be able to change, like switch that so that you guys can see it at home. Okay. We're going to go back to hedging bonds. And Ben, you're right. We're going to go back to hedging bonds, but I want it as a step to getting the bond equation. And the bond equation is basically going to be the Black Scholes equivalent, but for bonds. So we learned last time that we can only hedge, or we hedge one bond with another bond. So I want to consider it. We have two bonds, bond 1 and bond 2. And the bonds are functions of the interest rates that they float in, the time that it is now, and their expiry time. And the only difference between bond 1 and bond 2, the only difference between those two bonds is their maturity, when they expire. They both exist in the same R, in the same interest rate. They both exist in the same time. So the R for both is the same, the T for both is the same, little t. The only thing that's different is the expiry time. That's it. And we're going to hedge one bond with another. So our portfolio, we're going to buy V1 and short some V2. That delta, that's the number of bond number 2s that we short for every one bond number 1 that we buy. And we saw what it was last time. That was the ratio of the durations and things. So it has to do with their second derivatives? No. It has to do with their first derivatives with respect to the interest rate, and it had to do with their durations as well. So the thing that's changing is the interest rate, the thing that's like vibrating, the stock equivalent. When we were hedging for options on stocks, it was the stock that was changing, and that was driving the change in the value of the options. Now it's the interest rate. And we looked at a couple of, it was a Viacek model and Cox, Ingersoll, and Ross. We looked at a couple of those interest rate models, and they each have their strengths and weaknesses, and none of them are like super firmly established as this is the way that it works. Like the log normal stock movement is established. Well, is established, but I'm not going to say, comma, this is the way that it works. It's established, and this is sort of the way that it works and the way that we just deal with it. But I'm going to write down, I'm going to follow the notation of the book. There's some deterministic piece. Now that U, that's a function of, could be a function of the interest rates and time. We had that as a mean reverting for the Ingersoll and Cox and the Viacek one. Plus, we have some other function, which is also could be a function of the interest rates and time, dx. But all I'm doing right now is I'm assuming that the change in the interest rate is made with a deterministic piece. There's some model that you could agree upon later for the deterministic piece, and there's a random piece. There's some model that you can figure out later. So I'm being very general with that interest rate. If I want to know what dr squared is, this is where we're going to use that Ito's lemma, the same sort of structure as we would have done, as we did do when we were building the Black Scholes. That's going to be a u squared dt squared, too small. 2uw dt dx, too small, because quadratic variation, that dx is like a root dt. The only thing that survives is, or that isn't too small, is that w squared dx squared, and dx squared is dt. Why? We're assuming quadratic variation. So it's just like we did with the ds, where this was sigma squared. But remember, w is a function of, or could be a function of, the interest rates and time. So w squared is just that function squared. So when I see how does the bond change? Well, I'm going to write this out as a second order Taylor expansion, Ito's lemma again. It's equal to how the bond changes with respect to the interest rate, change in the interest rate. How the bond changes with respect to time, change in the time. Plus, now I'm going to go to the second derivatives, but the only second derivative that's not too small is the VRR, and that would be dr squared, because I'm going to pop the w squared dt in for dr squared. All the other derivatives, I'm going to write them down, but don't write them because I'm going to erase them in a second. There'd be like a half vtt dt squared, too small because of the dt squared. There's going to be a vrt dr dt, and a, divided by 2, and a vtr dt dr. Add them together, the halves disappear. Still too small. There's also, you might, so too small. You also might say, well, what about the change in the bond value with respect to its maturity time? That's not a variable. It's a constant. Once you create the bond, the maturity time is locked down. So we don't have any derivative with respect to capital T. So there's the only things that are like not too small for the change of a bond. So if I'm writing down, I got my portfolio here. If I want to think about what's the change in my portfolio, that's going to be dv1. So that's just me rewriting this whole thing, but the bonds are specifically bond number 1. So that's going to be 1r dr plus 1t dt plus 1rr. And I'm going to write in the dr squared. We know what dr squared is. It's w squared dt squared. So there's the change of bond 1 minus delta, which is a number, change in bond 2. It's just me writing this whole thing again, but they're all bond 2s. So 2r dr plus 2t dt plus 1/2 v2rr w squared dt. So there's the change in my portfolio. And we want to hedge away risk. So I want this change in the portfolio to have no random parts in it. Well, the random parts are the parts where there's a dx left, where there's some randomness. So it's this part is still random because it has a dr in it, and the dr has a dx in it. This part is random because it has a dr in it, and the dr has dx in it. So that's where we set delta equal to the derivative of bond 1 with respect to r divided by the derivative of bond 2 with respect to r. And that will cancel these pieces out, getting rid of the randomness. This is us hedging. When we do that, this piece and this piece cancel out. So what's left is our change in the portfolio is equal to, actually everything's got a dt on it. After I cross that off, everything's got a dt on it. So we've got a v1t dt plus 1/2 v1 r w squared. That shouldn't be dt squared, right? It should just be dt. dt minus, there's our delta, v2t dt plus 1/2 v2 r w squared. So this whole thing has a dt stuck on it, has one dt stuck on it. So I factored it to the outside. So if I hedge, the change in my portfolio is deterministic. So there is no risk. If it's deterministic and there is no risk, then the amount of money, so I could either buy this portfolio and it changes, it grows risk-free, or since we've got our no arbitrage assumption, I could take the same amount of money that V1 minus delta V2 would cost me, and instead of like buying the one bond and hedging another and shorting another bond, I could just take that cash and stick it in a risk-free rate of return, and it should grow at the same amount because this is now a risk-free investment. So this is where the no arbitrage kind of assumption happens. I could take this amount of dollars, pi dollars, and just invest it at the rate R for a time dt. So you could either set up this portfolio, this perfectly hedged bond portfolio, and it would grow at the risk-free rate for a time of dt, or just take your money and put it in a risk-free investment, and it should grow at dt. These should be the same. How does that sit with you? That's when this is like super reminiscent of the thing we already did, right? Yeah. And now, when I say invest pi dollars, what is pi dollars? Well, pi dollars would be V1 minus delta V2. That's how much pi dollars would be. So now I've got this expression dt equals this expression dt. I can cancel the dt's off both sides. Okay, let me write this in a flat line after I've canceled off the dt. That blue thing that I had written was V1 minus V1R, V2R, VT. And I've canceled off the dt's off both sides. They're both equal. So I'm going to get rid of these square brackets. And this is the expression that I've got now. This expression it's got, for bond number 1, it's got just plain value of bond 1. It's got the derivative of bond 1 with respect to time. It's got the second derivative with respect to bond with respect to time. It's got the second derivative with respect to interest rate. It's got the first derivative with respect to interest rate. And it has in it the W, which is the model of the random term. But it doesn't have any u's in it. That's totally what happened last time, right? What's last time? When we were building the Black Scholes equation. When we were building the Black Scholes equation, this was a ds, and this was mu s. And in my after I hedged it away, there were no more mu's. The drift in the stock didn't matter. Same thing has happened here. The random piece does show up, or the model of the sort of coefficient of the dx shows up here, but there is no randomness left. So that's sort like, so as I'm saying this, I'm thinking, well, this is working just like the just like the Black Scholes equation, except that I have 2 times as many like things floating around. In the Black Scholes equation, I was trying to price the value of the option, and there was V with respect to time, V with respect to the stock, which is like the R here, and V with respect to stock, which is like the VRR here. But that was, and just the V. But here there's like that for bond 1, and there's that for bond 2. There's like twice as many V's here. So my next sort of algebraic step is going to be take this expression and put all the things with 1, all the things that have to do with bond 1 on one side of the equal sign, and all the things that have to do with bond 2 on the other side of the equal sign. That's what I want to do. So these are going to stay. I'm going to make some space and to do some algebra here. But my goal is to have all the things with V1 over here and all the things with V2 over here. So just to talk me through it here, this whole chunk of algebra is going to go to the other side. And then I can divide out that V1R to the thing, and then this is all V2s. This RV1 is going to go over to this side. So I'm going to move this RV1 over, so it becomes a minus RV1. This whole chunk of algebra is going to go over to the other side. And now I've got a V1R and a V1R. I can just divide out the V1R on each piece. So divide both sides of this equation by V1R, putting that V1R on the other side. So I get, written nice and neatly, I get V1R, V1 with respect to time plus 1/2 W squared V1 with respect to RR minus R V1 all over. So after I do those algebra things that I wave my arm at, I'll get all the 1s on that side, and I get all the 2s on this side. And I feel like my algebra is correct. Because of the symmetry. The only difference between this side of the equal sign and the 2 side of the equal sign is this has 1s everywhere and this has 2s everywhere. So I'm going to erase this part. Okay, so what's the difference between bond 1 and bond 2 anyway? Like, I've been looking at the symmetry here. That's the only difference, is the maturity date. So if they each have a different maturity date, I should be able to, and this is always equals. So if I think about having a knob to change the maturity date for bond 2, if I turn it up or turn it down, I'm only changing stuff in bond 2. And I'm not touching bond 1. So this should be totally a constant with respect to the maturity date of bond 2. Exact same argument if I had a knob for the maturity date of bond 1, turned it up, turned it down. I'm only affecting stuff on this side. I don't change this side. So they both must be independent of the maturity dates. So they must be equal to a constant with respect to the maturity dates. So they must be both equal to something, and what letter did I call it? Called it A. Something that could be a function of the interest rates, could be a function of time, but it's not a function of the maturity dates of anything. It's not a function of capital T. So I could just look at this, and that just works for any bond too. It works for any bond, really. So I'm only going to look at this piece here equal to some constant with r's and t's in it. And if I multiply this up, or I guess I could multiply this up as well, I'm going to get the equation v1t plus 1/2 w squared v1 rr. That's the second derivative with respect to interest rate, minus rv1 equals a and I could rewrite that whole equation, switch everything from 1s to 2s. Since it works for every bond, I don't need to label this anymore. That's just true of a bond. I'm going to make it equal to 0 by moving this over as a negative. Why? Because I'm going to write the Black Scholes equation underneath it. So this is our bond equation as compared to our Black Scholes equation. And I guess at this point, we marvel at how really close they are. The Black Scholes equation, since we've got an established way that the S changes, the stock changes. We don't have general W's and general A's. We've got, a specific W, sigma S. We've got a specific A, sigma S. Everything else, but the structure fits. The structure's the same. How does that sit with you guys? But I still got to come back to the fact that I feel like I'm making this way more difficult than it has to be, because you're handing in that homework where you actually price a bond with a spreadsheet. There's no partial differential equation. You're just summing up the present value of the cash flows. What's the point of this then? Why make this into a partial differential equation? Right? The purpose of it is, or the thing we could do with it now is, I could say, if you can solve this equation, the Black equation, the bond equation, if you could solve it and get, a function of time and interest whose derivatives fit in here, and who at expiry is equal to the principal. I guess that would be like the condition, like the payoff condition. If you could find a function for that, then you will have solved this bond equation, and you'll have an equation where you can price this bond. But I already can price this bond, you're probably thinking. That's what I'm thinking. Yes, but in the way that we price that bond, we discounted all the cash flows with the same interest rate. An interest rate that we just, how did we figure it out? Kind of in a circular argument, right? We could find the yield of the bond, yield to maturity of the bond, by looking at the price and figuring out what discount interest rate they must have used to discount all the cash flow rates to get that price. And then I guess I could take that yield to maturity, plug it in my function, and out will pop the price. Yeah, that's how I got the yield in the first place. That's how I got the yield in the first place. So it feels like a circular argument to me. So this is a more sophisticated approach to pricing the bonds, where I assume that the interest rate can change stochastically, and I assume that not all the cash flows have to be discounted at the same number. But in the end, to value a bond, the value of a bond, or what the bond sells for, is you go into the market and it's a supply and demand meeting of the two supply demand curves or whatever that determines. It's the market that figures out what they're going to pay for it. In theory, they're following something like this, but it's only in theory. Okay, so, I'm going to get rid of this Black Scholes. It was just there for comparison. Since I can dump all the subscripts here, I'll just go with, that's how we got the, that was this A. And I guess what I would be thinking of at this point is, what's A? Well, we can write A as W times lambda minus U. Sure. What's lambda? What's W? What's U? Okay, wait. We do know what we do have functions, supposedly. So we assumed this, right? For our change in our interest rates. So we must have a model. We must have a U and we must have a W. So the U and the W are functions that we would have before we proceed down here. So it's just what's A and what's lambda. Well, this is A. Okay. What's lambda? Well, so the U and the W we have from our model of how interest rates change. The A we have by, if we can work out this expression, this must be equal to whatever this thing is. So then the question becomes, what's lambda? Lambda is just equal to that. So I can build the lambda, whatever A, excuse me, whatever U, W, and A I have, I can build a lambda that works for this expression. Okay. Why would you do that? Well, like, what is lambda? Why would I want to build a lambda? The argument is, say I own a bond. So this is what I'm... Now, what's lambda? A is a function of r and t. W is a function of r and t. U is a function of r and t. So lambda is a function of r and t. Everything's a function of r and t. So what's lambda? Say I own a bond, and the change in the value of my bond that I own, given by this second order expansion, I'm going to do Ito's lemma again. We're going to replace, like we did before, dr squared is going to be the w squared dt. There's still some randomness in this dr, right? This dr is the u dt plus w dx. So this change in the value of this bond I own still has that random piece in it. If I collect things together, like I want to collect the deterministic piece plus the random piece. So the random piece, excuse me, there's the random piece plus the deterministic piece. Okay. And this plus this is this plus this. So I could make that equal to RV plus AVR, according to the bond equation. So I'm swapping these out for RV plus AVR. And now I've got UVR plus AVR. Well, U plus A is equal to omega or W at lambda. So this piece here is going to end up being W lambda V sub R. So the three pieces that have a V sub R in it, I can put on one side, and this RV dt is going to go to the other side. So I'm going to end up with this expression. dV minus RV dt is equal to VR times W dx plus, well, I can take the W out as well. So I will. Can't I? Yes, I can. So that's the expression that I want. Why? Because this has some meaning here.
What are you, the second one, what's that equal to?
Oh, dV. So this is the expression that I wanted to get at, because it's algebraically saying something to me. That RV dt, that's how much money you would get if you took V dollars, invested it at the risk-free rate, R, for a short amount of time, dt. That would be the change in your money if I just put it in a nice, safe, the safest thing. dV, that's the change in your value of the bond. So this whole side is a comparison between the difference between how much money you made on your bond, your value of your bond changes, versus how much if you just would have took that money and put it into an interest rate making a risk-free investment with R. Or even like not a risk-free investment, but just cash paying that same amount. So this is the difference between buying the bond and just investing the money at the same rate. Which is kind of how that we're, like, when we're pricing a bond as the present value of the cash flows, we're kind of assuming that that's equal to zero, right? Because we're saying, you can take your money and invest it at the yield and get, let's just think about a zero coupon bond. Invest it at the yield and get the principal, or you could buy this thing now and get the principal at the end. We're saying it's the same. That's how we're pricing the bond. This is saying there could be a difference in that. Now, what is this difference? Well, it's proportional to stuff, but this dx is random. So this could be plus or this could be negative. If it's negative, then the difference between buying the bond and just investing your money is negative, and I guess you should have just invested your money then. If this dx is positive, well, then you did better buying the bond than just investing your money. But this is random. So whether or not you should buy the bond or should just invest at the rate R depends on that dx for that little change in your value. So it's a random thing. But this is positive. So lambda, imagine that I want to see for this little time step dt, should I have like just invested my money or should I have bought the bond? Well, the answer to buy the bond or invest the money is whether this piece is positive or negative, which depends on whether this bracket is positive or negative. This bracket being positive or negative is going to be decided by reach into a normal distribution and grab a dx. Could be positive or could be negative. But I'm skewing my answers by adding a little bit. So there's going to be, it's not like 50-50, because if I pull out a small negative number, I'm going to add a little bit to it. And that'll make my change either not as negative or maybe even positive. So that makes lambda the market price of risk. Or another way to think about it is my extra reward for taking the risk of buying the bond versus just investing my money. It's a measure of that. So that's my argument for like why think about A in terms of this weird expression. What's lambda? It's a way to quantify the market price of risk. Now, I underlined it in red and said it was positive, but I said that without any proof at all. But why should it be positive? Well, I guess baked into the idea, the market price of risk, baked into the idea of that is I should be rewarded for taking on more risk. Or the other way round of thinking about it is, if you want me to take on more risk, you need to balance it with more reward. So as risk goes up, reward should go up, I guess is all I'm saying. Which is going to be a segue into the next section for portfolios. But before we go into the next chapter, let's lock this down. Are we good with what we did? I haven't solved this bond equation. I'm not going to this semester. Next semester, we'll learn some finite difference ways to numerically solve partial differential equations. Those of you that can already solve partial differential equations numerically, and some of us you can just type it into MATLAB and go hit solve and it does it, right, mechanically. It numerically solves it for you, like a high-end Euler's method for solving ordinary differential equations. So we can solve partial differential equations using these techniques. We'll review those later. And by later, I mean next year. But I am leaving this kind of hanging like that. We're good? I shall erase.
Why is it hard to solve or something?
No, I mean, there's just like standard techniques that we need to learn how to work in order to solve them. We won't pretend that next semester in 736 that we learn all of the numeric methods for solving partial differential equations. In order to be really good at them, you should take a full course in partial differential equations, then a numeric methods course that shows you that. So we're not going to cram those two courses into like a quarter of a semester, but we'll learn enough to do stuff to solve it, so that if you get hired and you do need to do that as a job, that you'll only have to like read a little bit and then you'll have the foundation to catch up to what's going on.
So there's no close form for this?
There is before you get a closed form, you have to decide on what's the U and what's the W. So there is a closed form, and they go over it in the book. I have it in my notes, but I decided to skip it. If you use the Weizsäcker model, which was the simplest model, where the W was just root beta, then we have a closed form. And even then, when I did show it in previous iterations of this class, I didn't go through and solve it. I just said, here's the solution, and we verified that it was a solution. It's more involved than the Black Scholes, but it's very similar to it. And how long did it take us to do the Black Scholes? It took us a couple of lessons, right? So it's less well established as well. Okay, so new thing. Portfolios of stocks. We started out, what's a stock? Modeling stock. Options, modeling options, pricing options. Bonds, pricing bonds. But in each one of these cases, we were always like approaching the idea that we bought one thing. You bought one stock, or you bought one option and hedged it with one stock. That's not what you do in real life. If you get hired, the company is going to have you be, doing the math on like portfolios of thousands of stocks. They own things, and they'll own options and bonds, and you need to deal with a whole mixture of stuff. Okay, first thing we should do then is sort of ratchet up from owning one stock to owning a portfolio of stock, multiple stocks. So here's, just so that we can have something to point at here. Here's 5 stocks. I've labeled them A, B, C, D, and E. And here are their returns for every month. There they are graphed, or these are the actual stock prices. There they are graphed. There's the returns. We actually care about the returns, not the actual prices of the stock. So this sheet is just dealing with the returns of the stock. And I've got all of these monthly returns, and I've taken the annualized average to talk about the drift of that particular stock, and the annualized standard deviation to talk about the volatility of that stock. So we can all generate these items, right, from actual stocks. But when I look at them, the drift is, stocks with a big drift are going up. So it's a measure of my reward. The drift is a measure of the reward. The volatility is a measure of the risk. We just made that argument that if I take on bigger risk, bigger volatility, then you got to pay me with a bigger reward. So these are the stocks of which I'm picking. Now, there's only 5 because I want to have a workable example, but you could also be restricted, right? You could be working for some kind of a pension fund, and the pension fund says, here's a list of stocks you're allowed to buy. Why isn't this stock in the list? Because we voted that that particular company does something environmentally unethical, so we're not putting our money in that. So there's reasons why it could be restricted, right? It's a union pension, so all of the stocks you own should come from companies that have strong unions in them. So there's reasons why it could be restricted. My reason is I only wanted to have 5 things there so that we could learn. But let's take a look at our volatilities. That's the big, here's 0.53. That's the biggest value, our volatility. So stock B is the riskiest. Actually, it only the return is under 2%. So not only is it the riskiest, it's got the least reward. Stock B sounds terrible. I'm not going to buy that. What about A? A's got more reward than B, and it's got less risk than B. So I would certainly buy A over B. But C's got comparably the same risk. Remember, the volatility is it's a guide number. It's a fuzzy number. One is 0.448 and the other one is 0.445. If I would have taken slightly different data points, it might be the other way around, 0.44. But they're about the same. And the reward for C, the drift is higher. So far, I'm arguing that I should just buy D. Let's look at E. Slightly less risk, way more reward. So far, I should just buy D. When I put E into the mix, though, it's got measurably less risk to it. But it's also got measurably less reward. So with stocks D and E, I don't feel like I can just arm wave one of them away. They each have their advantage and disadvantage. So I should build maybe a portfolio out of like a little bit of D, a little bit of E we could go with. You would go with a lot of E if you were very risk adverse. So if this is a pension fund and every month you gotta pay the workers their fixed income, this retired guy needs to get his money every month. So you can't like take a risk, the whole thing drops and you go, okay, we'll get you next month. The guy's got bills. So then you're gonna lean towards the no risk one. So here's a combination of, you take 50, so this is the weighting. If I take 50% of D and 50% of E, then here's my returns. It's just 50%. So the returns are 50% of return D and 50% of return E. If I look at the screen here for the dots, what's graphed? This is my risk here as the x-axis, and this is my return here as the y-axis. So here's all this. Oh, this is the stock. That's stock D, pure stock D. It's got the highest return. It does have the highest return, right? No, my bad. It has the highest return, but it also has the highest, it has a high risk. This is the high risk, low return. That's B. This is the D. So they all have about the same risk, so I'll go with the one with the highest return. So out of all these, like this plot is a way to put risk and return, and this stock is good because same risk but high return. This stock is good, that's E, because it's got the smallest risk. But take a look at, this is the weighting. How come it's not, like, it's even less riskier than just buying that, totally buying that E. So by mixing in half of that higher risk, higher reward stock, I've ended up with a lower risk, higher reward portfolio. Because when we started talking about the two stocks, it seemed like we would just decide on how risky we were. And if you were like super risk adverse, you'd buy all E. If you were super brave, you'd buy all D. If you were like halfway brave and halfway risk adverse, you'd like go half and half and you get some kind of mixture. But it looks like if you're super risk adverse, you should mix in that other one. What's the what? Why is this happening? And before you answer that, what if I turn this around to be like 40% one? The dot moves. If I go 60% weighting, so by changing this weight, I can move around out here, but it always seems to be like better than both. Better than both individually. This next sheet then, there's D and E, and here's the weights. So at 50-50, that was in between here, and so I could calculate the what's the drift and what's the volatility, and that's each one of these points. So that's like I'm moving around here by changing the weights. This is like all the weights. So 0 would be like all of stock E and none of stock D. 1 would be all of stock D and none of stock E. What about these negatives? How can you have negative weights? Yeah, you sell, you short one stock and buy more than you normally would of the other stock. Yes. So I can have negative weights. So I stopped, so negative weights here is shorting one to buy more of the other. That's the exact same here. 1.8 means I must have shorted 80% of my weight in one stock, taken that money and bought 1.8 times of the other stock. So the weights always add up to 1. And so by moving around here, I'm just tracing out this, well, it's a parabola. And at this point then, this is called, if we want to connect it to a finance class, this is called the efficient frontier. And this is where I want to be on this frontier.
Do all of these stocks have the same prices? Like, do you have the same price to buy them?
No, but our weights are on the amount of our money that we put in.
Okay.
So the weight, by weights I mean, like if I'm at 60-40, I'm taking 40% of my money and putting it into stock, the first stock. It could be that stock's super expensive, so I only get to buy a few shares, but 40% of my money's in. That's why working with the returns, I don't have to worry about what the actual value of the stock is. I just need to know how much of my money's in that stock.
So then, like for -1, you sell the amount of, if you short the amount of D that's equal to the amount of money you had originally.
Yes.
Okay.
Yeah. So it's the fraction of my bankroll that's going in. So I want to do everything as fraction of my money. That way when the stock, our argument, if the stock is in a different currency, it doesn't change anything what we did. We're only working with the returns. It's become less and less important what the actual value of a stock is, because now we can just buy fractions of it. It's just kind of a psychological thing now, I think. Right? There's no reason when a stock goes up to $100 and they split the stock, giving you so they take in the $100 share and they give you back two $50 shares, so you have like twice as many shares. Yeah, but they're worth half as much. The money you have in the company is the same. They used to do that more for a psychological reason. So in some stocks it was psychologically better for the stocks to have a lower cash value. I'm thinking of penny stocks, mining stocks. When I grew up, everyone was always, like up north, we were always like, companies would form and we're going to find a gold mine. You hear rumors, so-and-so's prospecting company found a gold mine. You'd want to go buy some of their stock at the exchange. I would go with my dad. You'd have to physically go down there and like in this office. It was always dirty for some reason. But anyway, you'd buy, and the stocks would always trade for like a couple of cents a piece. So you could show up with $1,000 and buy a huge amount of stock. So it felt like, wow, I own like a big chunk of a gold mine. But it doesn't matter what you value it. You own that many dollars of a gold mine. Usually you ended up owning just some bit of a forest. But anyway, it was the thing. But for other stocks, it seems to be psychologically advantageous for them to be higher. Right? Things like the tech stocks, Tesla, Google, it gives them good feedback when some news report says, Google's trading at such and such $1,000. Makes you think, wow, that's a good company. But It's their returns that's important, not necessarily what their value's at. Anyway. So these are all the different combinations of these two stocks. And now all I have to do is decide. I got two things to think about. I can decide how much money I want to make. So in other words, I can decide on the return I must have. And let's say I decide it's got to be 40%. Well, then I know I should be at this particular point, and I'm going to, because that's the desired return that has the minimum risk. Or the other way around, you could say, you could pick a maximum risk. So I need to be a risk at 0.3, and you could go up here and find the point, that's the return. And this would actually tell you what the mixture is going to be. Oh, it's here. But of course, this is only for two stocks. So it's actually a one variable problem, because once you know how much of your weight is in stock, the first stock, then the other weight is just 1 minus that. That's what I wanted. So this is the same thing as I did here, but here I only had the two stocks. So I just mechanically, systematically went through with all the different weights. In this plot, I had 4 different stocks. So I didn't think of a clever, systematic way to go through all the weights. Once you decide on the weights of stocks 1, 2, and 3, the 4th weight is predetermined because all the weights have to add up to 1. But I didn't think of a clever, systematic way to cycle through those 3 choices of weights. So instead of clever, I went with brute force. I just randomly selected. So each one of these dots is a random selection of weights of stock 1, of stock 2, and stock 3, then the weight of stock 4 is predetermined. Then I've got my weights. I can figure out the average or the returns and the risk of that portfolio, and it's putting a dot here. So this is still this parabolic shape. I still see this parabola here. We'll see that in the math. I guess we'll see that on Thursday. But now it's not so clear, right? Like when I'm looking at this picture and I say, oh, I want to be at that dot. So on the spreadsheet, it's a one-dimensional problem. You decide on what risk you want. You sub in and solve for what the weights determine that risk to be on that particular point on the efficient frontier. All the dots there are on the efficient frontier. Slight lie. I'm totally ignoring this negative piece here, right? Like I would never do this because I can have the same risk and more reward. So I chop this. I'm chopping it at the bottom of that parabola, like here. But in our case, this becomes a multidimensional optimization problem. If I decide I want to have a risk of 0.6, I know I want to be out here. From the picture, I know what sort of reward I can manage to get, but I don't know what this mix is. So I'm going to have to do a multidimensional optimization problem to figure that out, which just turns into multivariable calculus, right? We'll look at that. So that's where I want to pick it up then on the Thursday, where we want to derive some kind of a formula. Now because what am I doing right now? What I'm doing right now is I'm just taking these, I'm taking the returns and say this is at 60%. I'm taking 60% of the return of D and 40% of the return of E. And that's giving my return for that month. So these are the returns for my portfolio. And then if I want to know what's the drift of my portfolio, I'm just taking the annualized average return on the portfolio. If I want to know what's the volatility of my portfolio, I'm just taking the annualized standard deviation of those returns. On Thursday, we're going to make up a formula where I can just do it with the drifts of the particular stock. I don't have to go all the way back to the data and update the data each time. Questions on what we did today then? I'm in chapter 21, by the way. I'm starting chapter 21. That's what we are. I guess that's a no. Okay, I will let you go.